So let's look at the last part of our series, which is preparing the cash budget itself. And remember, we've got an income budget and a cash budget. The cash budget is concerned with cash actually coming in and out of the company and our bank balance, whereas the income budget is concerned with income expense items, and those aren't always necessarily the same. So we're starting our first quarter with the beginning cash balance. So this would have been the ending cash balance from the prior year. We've got $115,000 in our bank account. Then we're going to add our cash receipts, subtract our cash disbursements or our cash payments, consider any minimum cash balance we may have, and then talk about financing. Do we need to borrow, or are we going to need to repay during this quarter? Very important section down here as well. So let's walk through the first quarter. So if we go up to the problem, here's our cash section here. And we see our minimum cash balance. This means we want to keep at least $100,000 in our bank account at all times at the end of each quarter, or at least at the end of each quarter. Then we've got income taxes, so we're going to be paying those out in quarter one. We've got equipment we're going to purchase. We're going to pay that out in quarter two. Looks like we're going to do some borrowing and a repayment. There isn't anything up here about additional cash funds coming in. So in that case, we can assume that the only cash we have coming in is from our cash collection schedule. So these are our customers that are paying us for our sales. So we've got our cash collection figure down here. Remember that we're wanting to see what we've got coming in for cash and not necessarily what's on the income statement, because we're not going to get paid in the same period that we make these sales necessarily. So for quarter one, the incoming cash we have is $209,500. So we're going to scroll down and put that down there. And as I mentioned earlier, we didn't have any other income coming in. So we're just going to put a 0 there. Now we're in our cash disbursement section. So we're looking at cash payments that we're making. So cash that's coming out. So merchandise purchase is the primary one. That's the largest cash outflow. So let's look at that line. This was our schedule of cash payments, and these were our cash disbursements for the first quarter. So we're going to put that figure in for the first quarter. Other cash outflows or cash disbursements we have are from our selling, general, and admin budget. So let's go look at that figure. And again, remember, this is our net income, but we took out any non-cash items that were included in their net income to give us our cash figure here. So we've got $55,000 in cash coming out for our selling and admin budget for the first quarter. Then we've got some irregular cash disbursements for equipment purchases or for income taxes. So let's look at that. So for quarter one here, looks like our income taxes. We paid our income taxes for the prior year in quarter one. Equipment purchase isn't going to happen until quarter two. So let's put this income tax in for the first quarter. So we've got total cash coming out of $248,160. Now we need to consider, do we need to keep a minimum balance? So if you're looking at this right now, we've got a balance of $76,340 theoretically in our bank statement as of the end of quarter one. And that is a surplus. It's a positive number, so it's a surplus. A negative number would be a deficit. We've got $324,500 coming in. Subtracting out our $248,160 gives us our figure of $76,340. So we look like we're in a pretty good position, but remember that we want to keep a minimum cash balance, which may be more than this. So let's scroll up and look and see what our minimum cash balance is. And sure enough, we have a minimum cash balance here of $100,000. So we want to keep at least that amount in our bank account as of the end of every quarter. And companies often do this just to make sure they don't overdraw. So we've got to put $100,000 in there, and that's going to change that number. We're no longer going to have a surplus. We're going to have a deficit because we only had $76,340 in our bank account. That's $23,660 shy of $100,000. So this indicates we're going to need to borrow to keep that minimum cash balance. Now, in reality, a company may decide when they actually get to this point that it's not worth it to borrow. Maybe they're going to have money coming in really quickly and they can make it through the end of the quarter, but maybe they're not. So in this example, we're going to assume they're going to want to hit that 100,000 and they're going to need to borrow some money. That's where the financing section comes in. Let's scroll up and see how much they said they wanted to borrow. So in this example, they said they're going to borrow on their line of credit in the first quarter for $25,000. So they want to borrow $25,000, and a line of credit is like a bank loan. A line of credit is just a revolving line that you can constantly draw down and repay. So we're going to put $25,000 in that financing section. And that's going to be in the borrowing line. They're borrowing additional funds. So now we've got an ending cash balance. What we've got in our bank account is just over the 100,000. We've got 101,340,000. So we've met our minimum. Let's look at quarter two. So we've got our collection from customers in quarter two, and we already determined that was going to be our only income source, or our only cash source for the purposes of this exercise. So quarter two, our actual cash collections, 217,000. Don't have any cash coming in from any other sources. Merchandise purchases for quarter two. This was our cash payment or cash disbursement schedule for quarter two. That was $117,720. Our selling and admin budget, our cash disbursements were $55,000. And did we have any other cash flowing out? Any other equipment or income taxes we had to pay? We were given. We already took care of the income taxes. That's done. Equipment purchased in quarter two. So we're paying cash for equipment in quarter two, $42,000. So let's go fill that in. Income taxes, we paid those in full, so no more income taxes to pay. Again, we've got our minimum cash balance, so we need to fill that in. It's always going to be $100,000. So look at that. We just barely are going to cover that. We're not going to need to borrow because we're going to have $103,620. We're just barely going to have a little bit above the $100,000. So no borrowing will be needed in quarter two. And if you scroll up here and look, you can see that they're not talking about any borrowing. The only borrowing they did was in quarter one. So let's go on to quarter three. For quarter three, cash collection from customers. Let's back up here, $226,500. We already determined we didn't have any other cash inflows. Merchandise purchases for quarter three. So our cash coming out for quarter three, $135,960. Our selling, general, and admin cash coming out. Cash disbursements, that's $55,000. Do we have anything else going on for quarter three? And we go up here, we can see that, okay, in quarter three, we're going to repay the loan in full along with $500 for interest. So how do we know what's in full? Well, we borrowed $25,000 in quarter one. So when we pay it in full, we're going to need to repay that full $25,000 plus $500 in interest. Scroll down here. So before we put that repayment in, let's remember our minimum cash balance. We have to have that in every period. And if you look at that, you can see why we didn't repay our loan last period. After the minimum cash balance, we didn't have enough to pay it in full. We would have barely had enough to make maybe a small payment on it. Whereas in quarter three, we've got enough to pay it in full. So down on the financing section, this is the only section where you've got both cash inflows and outflows. So a cash inflow will be a positive number in this section, and a cash outflow will be a negative number. So a cash inflow in financing is when we're borrowing money, we're putting money into our bank account. A cash outflow in finance is when we're repaying the money, we're taking money out of our bank account, giving it to the loan. And so we also repaid $500 in interest. So that's also a cash outflow, money coming out of our checking account. So if we look down here, after we've done that, you can see we do still have our minimum balance. We've got more than 100,000. So our ending balance at the end of quarter 3 is $113,660. I'm just going to fill in the quarter 4 fairly quickly so we can get to through the last bit of it here. So quarter 4, let's go our cash collections from customers. Back up here, 227. Our merchandise purchases was right here, cash disbursement schedule, 139,280. And we know that 55,000 was our selling in general each period. It was right there. And we didn't have anything else special in quarter 4. So I'm just going to put in my minimum balance. There were no extra loans, nothing else happened there. So our ending cash balance for the end of the year is $146,380. You can see that's the same on the year column as well as the end of quarter 4. It should be the same. So that's how you prepare the cash budget.